Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 30th edition of Market Outlook. So, pretty sloppy week. We ended up pretty much on some weakness after the news about the FBI investigation of Hillary. But let's take a look empirically at what the market's telling us. Well, you can see actually this week, for the week, the Dow actually closed pretty flat, and that the Russells here were the weak sister, and that's really the big determination of primarily the U.S. economy. And you did have some weakness after Amazon reported in the Nasdaq 100, so a little weakness with FANG. But on a positive note, we had been really pretty negative on accumulation versus distribution days, and we have picked up a couple of accumulation days over the past couple of weeks, which is an improvement when we had zero. So net sort of mixed results here. I give overall volume sort of a neutral read to slightly negative, although did improve over the last couple of weeks. Additionally, of course, this week's price action pretty tenuous. And let's go to what our sectors are telling us at the moment now. So we had some continued weakness. As you know, we like to look at sectors and see uniformity and all of the family of sectors moving up. But what's happened here, as we move sideways to down this week, we lost the real estate sector as a positive sector, having 6-month positive change. And so, in essence, we got some further weakness. As you can see, the number of sectors up has been absolutely trailing off during this whole compression period. So I look at the whole sector picture, definitely a bit weaker and deteriorating. But the interesting thing is we really haven't been able to break down or above this compression zone, which is pretty rare. I think it's one of the rarest amount of compression days at a new high since the mid 1990s. So this type of pattern here, without seeing more of a sell-off or a resume move back to the upside, fairly unusual. So I look at this. I do see overall semiconductors still in a bullish mode and outperforming the benchmark S&P. So that's a bit of a positive as well. And of course, over the week, financials did better with interest rates rising as those larger financial institutions have an ability to make a bit more of a margin on their products. Okay, so now let's take a look at market hotspots and see what that's telling us. Couple of interesting things. Copper, right? Sort of inflationary indication, up 5.5% over the last week. That's a really interesting development. The other things you can see is we moved back into a warning phase with sugar, took some profits in that one, had been in that since early April, and we're now leaving that trade as it broke the 50-day moving average. So, some commodities definitely giving you a sort of a mixed message. And that is really the core of what's happening right now. Let's take a look at some of the market internals. And then I'm going to move on to some of those risk on, risk off indicators as well. Well, first of all, let's take a look at what we have here in the S&P. And as you can see, we bounced off the lows. Let's take a look at what we had here. We sort of had that marginally oversold condition across the board in up-down volume. The McClellan, which looks out over the next 2 to 3 weeks, and our shorter-term advanced decline indicator. And we got a little bit of a pop, but really nothing much. So the way I look at it right now, you move back above that 50% level and now below it. I look at the market internals here as more of a neutral to a negative overall in the S&P. Let's take a look at our next chart, which is a similar read on the NASDAQ composite. And as you can see, one feature here is we did break down beneath the 50-day moving average and a similar read. We're not oversold, but we are now in a situation where our up-down volume just passed through the midpoint threshold. That's a negative. The McClellan sitting on a low, the lower levels, but can get quite a bit lower on a sustained sell-off. And again, advanced declines really can't get going. So what I'm seeing here is a non-confirmation of that breakout above the 50-day moving average, putting this thing into bullish, moving back into a warning phase with some more potential room on the downside. So I look at the overall market internal structure for NASDAQ also weakening. Okay, let's take a look at, okay, this is new high, new low ratio, and you can see we're sitting pretty much right at that 70% level. I look at this as this can flip into positive territory with a rally rather quickly because this is a critical level, the 70% level, and you're sitting right here. So additional follow through on the downside, obviously you'd get confirmation. So I look at this as a neutral right here. Can't get a read, but obviously any follow through on either side is going to add to whatever case this breaks, the market breaks to. So can't get much help from this particular indicator. It's not leading or lagging. It's just sort of neutral. Okay, let's take a look at a similar chart. Hold on. We just looked at that. Okay, here's where we want to go. So this is looking at the volatility index, the VIX. As you can see, you're still inside the Bollinger Band. Obviously, that sell-off on Friday, you had a nice little pop, sitting still under the longer-term 200-day moving average, or just at it. But inside the Bollinger Band, I look at this as a slight deterioration in the overall picture, but more of a neutral reading at the moment. So you're not really frothy on the upside or the downside. I don't get much of a read here as you're in the middle of the Bollinger Band, and that's our core indicator for looking at sentiment. Right when we get to the outside extremes, you can see that the market's under pressure, and as we move back inside the band, it tells you that that signal is now abating. But right now, we're neither in either of those cases or any of those cases. So pretty much just a bit of a deterioration because we moved back above the 50-day, but still touching the 200 and within the Bollinger. So I look at this as more of a neutral overall as well. Okay, let's take a look at another way to look at sentiment. And as you can see, we did get to what we would consider pretty, the beginning of rich levels, and now everything is moving down. So volatility, as you can see, as a sentiment indicator, definitely pointing to a more negative scenario. And you've got all of our moving averages of the sentiment indicator, which is the spread between short-term, 1 month and 3 month volatility, starting to point negative. So definitely more of a negative reading here at the end of the week. Okay, and so that's it for the market internals. So net, you can see a bit of more deterioration overall, and in essence, more room potentially for the downside. But again, the key part here is, are we going to break this key 212 level, a new closing low, under 212 would be a definite, upgrade in our concern about the markets, which then could put a test down to 207, 208 level. So, that's a pretty decent 2-3% correction in the works here, if in fact we do take out on a closing basis this 212 level. All right, now let's take a look at some of the indicators I was talking about, the intermarket relationships of risk on, risk off. So a couple things to note. One of my favorite is using the spread between the S&P 500 and utilities, right? People run into utilities when they're concerned about the safety of equity investments. And so right here, right, this is our daily chart. You can see moving back under this black line, which is about a 1 month moving average of the ratio. And we have now spent several days under it, confirming it. This over here is on a weekly basis, and you can see we got about 2 weeks now confirmation. So in essence, you definitely have at least the beginning of increased concern by market participants. This is definitely a flag or a yellow sign here on risk off, right? Utilities outperforming stocks and breaking down here. Now, one thing, as you can see, is utilities on its own chart not able to take out its 200-day moving average or the 50 as well. So in essence, also a point of concern as well. So you've got sort of the overall market, the S&P, in a warning phase under the 50, and the utilities, even though it's outperforming, already under the 200. So not a lot of places to hide. Lightening up, being in some cash may not be a bad thing to do if you're going to base this off of this type of indicator. But we have a couple of others that I like to use in conjunction. So let's take a look at that as well. Okay, so what we're going to do is, hold on, take a look at some other risk on, risk off indicators. On the positive side, I want to point out that what normally happens, right, if things are really under pressure, this particular part of the chart here is the difference between high yield debt and TLTs, or the bonds. As we know, bonds have been under big pressure. But look what's happening here. This spread continues to hold nicely, and actually the higher yield debt is holding its own, right? It's holding its own relative to bonds, right? If there was stress in the system, normally the high yield debt, which is not as safe, would be under stress. So this is a contrary signal to what the utilities are saying. So that's a positive sign right there. Now, the other thing I want to note is taking a look at SPY versus gold, right? The S&P versus gold. Now, look what happened here, right? When the S&P is, right, the red line here, the ratio is above the two moving averages of the ratio, then you're in positive mode, SPDR outperforming gold, which is a positive for the market, right? When gold outperforms the S&P, not a good sign, showing signs of stress, looking for alternate currency, looking for some alternative asset class other than equities. And that really weakened, especially on Friday, where it sort of generated a signal where the ratio now on a monthly basis has moved into favoring gold. So there you've got this, mixed message there, right? You got some of these risk on, risk off indicators in positive territory for risk and some negative, but overall weakening. Now, the other thing that's interesting to note is looking at some commodities. And what I like to point out is copper. And if you look at copper here, you can see copper has really moved up nicely, right? So we've got all of this basing action here. And what's happened is certainly on a spread ratio basis, which is this chart right here, you can see copper moved out to positive territory in here, right? Hence this move up. Now, what's also interesting on our real motion indicator, which is really looking at momentum of price, right? As price is sort of moved sideways here for well over a year, the momentum, our longer term momentum, which is this green line, has steadily been moving up. And even on this sell-off, which looked pretty ominous, it never violated our longer term momentum indicator. So definitely strength building up in the commodity sector. Interesting that it's copper, right? Copper is usually a good indication of economic activity. This is the first time it's really been picking up in a long time on a relative basis in a pretty strong way. So it'll be interesting to see if all this sideways action and this upwardly sloping momentum indicator, along with this improved ratio here, will get us to a real rally here in copper. So, these are some important shifts. Definitely, we've looked at gold, we've looked at the high yield debt, we looked at utilities, we're looking at copper here. That's pretty interesting mix here. And there is definitely a shift going on between commodities, gold, the equities market that's looking heavier. And these are the themes that we need to keep our eye on and trade in alignment with. All right, hope this helps. See you next week. And hopefully this election gets behind us and results in a positive outcome and overall calm in the country.